Welcome to Food and Facilities, an online show for Planting to Processing Magazine, formerly West Coast Industrial Solutions Magazine. Watch what you read for safety, compliance, and innovation news within manufacturing, agriculture, food processing, and food and beverage industries. In this episode, we will be discussing the Paycheck Protection Program, or PPP, loan forgiveness with David Hathcote of Irwin, Jackson, Hathcote, and Wang CPAs. And we will be discussing research and development tax incentives with R&D tax incentives, Ron Beglin and Carol Burke. Welcome to Food and Facilities. I'm Tara Sweeney, the Marketing Director for Planting to Processing Magazine, formerly West Coast Industrial Solutions Magazine. And today we'll be discussing planting the PPP loans and the R&D tax incentives with David Hathcote of Irwin, Jackson, Hathcote, and Wang CPAs. You can reach him at dhatcoat@ijhwcpa.co, or you can give him a call at 415-601-5385. Welcome, David.
Thank you for having me, Tara.
So can you give our readers and listeners a little background about yourself and your firm?
Sure. Irwin Jackson has been in the Fresno area for well over 30 years, and I had joined them in May of 2019, so I'm about 2.5 years in here. Prior to that, I had worked for 3 of the 4 big accounting firms, the international accounting firms, both in Fresno as well as the Bay Area. The last several years with them was doing creative tax strategies as well as serving clients. Since joining Irwin Jackson, of course, then we end up with the pandemic, and boy, all kinds of things have happened since then, and it's been quite a wild ride, but exciting.
And you're going to discuss with us today the CARES Act and the PPP loan section of that act. Can you give us a little background?
Pardon me?
Can you give us a little background on the act and how it started and everything?
Sure. So as everybody knows, the pandemic hit at the beginning of last year, and by the time March had hit, the economy in the United States as well as worldwide had sort of really gone into a free fall, and Congress was trying to sort of slow the downward spiral, and they came up with the Coronavirus Aid, Relief, and Economic Securities Act. The acronym for that is CARES, and inside that act contains some provisions for the Payroll Protection Program, the PPP program, and in that they had allocated billions of dollars to try and help small businesses keep people on their payroll and essentially keep them from going bankrupt. So we're going to talk about the CARES Act, and then a little further down we will talk about the subsequent bill that came out where Congress had appropriated more money for the next PPP, as well as what President Trump had signed in December of last year with regards to a renewal of the program. Also sort of interspersed in there, we're also going to talk a little bit about the employee retention credit, which was part of the CARES Act and also part of the December 27th of last year bill that President Trump had signed. So, excuse me, many of you on this that are watching this podcast probably know something about the PPP program. Many of you probably took it, and if you did not take a loan, you certainly know somebody who did. But we'll go over sort of the basic framework of that program as we lead in and move forward into some of the newer ones. As many of you know, the loan was granted by a borrower's bank, but it was backed by the Small Business Administration, the SBA, which sort of falls under the direction of the Treasury Department. And borrowers were able to borrow essentially 2.5 months worth of payroll to help them get through what I think at the time people thought was going to sort of be a short-term hit to the economy. Obviously, now we're I think coming up on a year since the first person in the United States died, so it's certainly drug on longer. The original bill allowed borrowers to either look at their full 2019 payroll or the 12 months prior to the date in which they took the loan out and calculate what their wage expense was. As part of those wages or the wage expense, it included benefits such as vision and health care, disability insurance, as well as state and local taxes such as the state unemployment tax. So what the borrower would do is take a full year's worth of those payroll costs that I just described, divide by 12, and then they got 2.5 times that amount, and that was called the maximum loan amount. And it was available to businesses who at the time the Congress had defined as small businesses with employees less than 500, and part of that was businesses that had 500, including the affiliates. So if you had two brother sister companies or two companies with similar management, you would have to add those together to determine whether they had 500 or less employees. There was an exception to that for businesses in the restaurant and hospitality industries, and in those cases, they allowed the restaurant and hospitality businesses to look at their per location numbers and make sure that they didn't have more than 500. Some notable ones was I think Olive Garden or some of the other big chains that ended up getting tens of millions of dollars because they ended up having multiple subsidiaries and they were exempt from this count. Congress sort of cleaned that up later. In order to calculate the maximum loan amount, wages were limited on a 12-month basis to $100,000 per eligible employee. And in order to get the loan forgiven, the borrower had to prove that they had used 75% of the money on salaries and wages, including all those things that I just talked about. But the other 25% could be used for utilities and rent and mortgage interest. And at the time that made sense, because in order to get the loan forgiven, the borrower had to spend the money on those things, but they had to do it in 8 weeks. So essentially they were calculating their maximum loan amount on essentially 10 weeks. So it was 2.5 months, the average monthly payroll times 2.5, which works out to about 10 weeks. And they had to spend it within 8 weeks of the date that they received the loan. Whoops, sorry about that. At the time, we were trying to scramble, and most of my clients were scrambling to try and project out a model what amounts they needed to spend on payroll and what they needed to spend on rent and other things within that 8 weeks to make sure that they got the entire loan forgiven. Interestingly, for the amounts that were not forgiven, then that would convert to a 2-year loan at 1% interest rate. So it was unbelievably low interest rate borrowing that didn't have to be paid back for 2.5 years. Also buried in the CARES Act was an employee retention credit. And almost none of my clients and most of my friends that own businesses, almost none of them took this employee retention credit because if you took a loan under the PPP program, then you couldn't get the employee retention credit. But for those people who didn't take the PPP, they were able to take the employee retention credit, but only if they had a 50% reduction in their gross revenue in any quarter of 2020 when compared to the same quarter in 2019. Well, that 50% is a pretty high bar. And so very few taxpayers, I believe, were able to take the employee retention credit. I'm sure that most of you heard that the original appropriation of several hundred billion was gone within, I don't know, 2 or 3 weeks, and that most of the headlines were that giant publicly traded companies and private equity funds and hedge funds had been huge recipients of this, and that the small business, many of the ones that are in the valley here, they were left out of this program. And so Congress reappropriated several $100 billion more money for new loans. In that same bill, which was signed on June 5th of 2020, as you see there, in that same bill, they extended the time that borrowers could use the money from 8 weeks to 24 weeks, which then essentially made that almost everybody should be able to get their loan forgiven, because they were borrowing, as we talked about, 10 weeks of wages and being able to spend it over 24 weeks. So essentially 2.4 times what they were getting. Another thing that they did, which had they not changed it from the 8 weeks to 24, it would have been a much bigger and more beneficial provision, but it essentially extended the amount that could be used for other items from 25%, where 75% had to be used in payroll, to 40%, where only 60% had to be used in payroll. And those other non-payroll items, as I mentioned, was rent, mortgage interest, and utilities. They were still eligible for forgiveness under the amendments to the CARES Act from June. But essentially, it's easier for borrowers to apply for forgiveness by not bringing those other items in. And since most of them were able to spend the amount on payroll, then the 60-40 split wasn't nearly as important as it might have been had they not extended it. Also, in the June 5th bill, they allowed businesses 6 months to rehire their employees. So if their numbers had dropped, they had 6 months to try and get their headcount back. Because in the original CARES Act, if a business had reduced its headcount, or it reduced the hourly rate or the annual salaries of any of their employees, those reductions would have to come off of the amount that could potentially be forgiven, the portion of the loan that could be forgiven. And so Congress has allowed 6 months for businesses to rehire them. And they also put in some other exceptions for the restoration of employment, and almost all of the provisions in this June 5th were taxpayer and borrower friendly. Again, Congress was fearing a free fall in the economy. And the last thing that I'll mention here is that they extended the non-forgiven loan amounts to 5 years from 2 years, still at 1%. So really, really unbelievable terms for borrowers. After the business borrowed the money, they would count forward 24 weeks, and then after that 24th week, they could apply for forgiveness. So originally, the Treasury Department and SBA came out with Form 3508, which was just a complex, detailed, multi-page application to try and get the loan forgiven and provide documentation proving you'd used the money on the items that Congress had intended. They then came out with the 3508 EZ, which was intended to be easier, which I guess easier is sort of a term of art. And yes, they were easier, but still fairly complicated. So hearing the pushback from trade organizations and other lobbying groups like the AICPA, American Institute of Certified Public Accountants, the Treasury came out with what was called the 3508S for small borrowers. But it was only available to borrowers that had taken loans of $50,000 or less. So while there were a lot of borrowers who had less than $50,000, there were still quite a few people that were going to be stuck with the 3508 EZ. The slide here says loans less than 150. That came into play in the bill that was signed on December 27th of 2020. Let's see here. So at the end of December, Congress came back and they wanted to do some more relief money and some stimulus money, and they had also needed to deal with essentially funding the government for the next year or two. And instead of doing two separate bills or multiple bills, they decided to throw it into one, and they called it the Consolidated Appropriation Act of 2021, or the CAA-21 for short. And that bill is 5,593 pages, and it included in it is funding for the government and aid to foreign countries and all kinds of things that most of the time citizens in the United States never even pay attention to. But since it was buried into a relief bill, all of a sudden some of these things that the government funds became sort of under the microscope, and I'm sure that you heard some discussions of them in the news. But the most important things that we need to worry about and that we have any control over were some of the stimulus and relief provisions that were in there. And one of the sticking points, probably one of the biggest sticking points of the original CARES Act, is that Congress had intended it to be non-taxable when the loans were forgiven. Most loan forgiveness is taxable. So if I loan Tara $1,000 and she doesn't pay me back, and we both decide, okay, she never has to pay me back, then that becomes taxable income to her. So in essence, just under general tax law, the amount of your PPP loan that was forgiven would ordinarily be taxable, but Congress had specifically said that the PPP loan forgiveness would not be taxable. So the IRS, in their infinite wisdom, came back and said, okay, Congress has said it's not taxable. That's fine. But we think that the expenses that you had or had incurred to prove that the loan was forgivable, your wages, your mortgage interest, your rents, and your utilities, well, to the extent that you use those to get your loan forgiven, well, you don't get to deduct those costs. So therefore, the IRS essentially turned what was supposed to be a non-taxable loan forgiveness into essentially a taxable loan forgiveness. Well, everybody was up in arms about this. Even both sides of the aisle in Congress said, no, that's not what we intended. So one of the biggest fixes they did in this CAA-21 bill was to explicitly say that the amounts for the loan forgiveness are non-taxable, and all of the expenses that were incurred to get the loan to be non-taxable and forgiven, you can still deduct those. So that was a big win for taxpayers. I mentioned that the bill was 5,593 pages. It's a beast. I haven't seen much like this in my career. So also in the bill, the original CARES Act expired, I believe, in August of 2020. And there were still some unappropriated amounts in there, unused amounts that had been appropriated in that March bill. And so Congress had decided to do another round of PPP borrowing, which I'm calling the PPP 2.0. And I have gone back and sort of in my head labeled the first round under the CARES Act, the PPP 1.0. So in the PPP 2.0, they allowed borrowers who had missed the cutoff, the August expiration date on those funds, to go and make what they now call a first draw loan under the PPP 2.0 program. And it essentially uses the same rules that existed with the PPP 1.0 loan. Also in there, though, they added a PPP 2.0 second draw provision that allowed borrowers who had used the money under the first loan for the appropriate expenses, they allowed them to take out a second loan, which they're now calling a second draw. The appropriation and the amounts appropriated in this bill from December was $284.5 billion. They put some additional restrictions on it for the second draw loans, but with regards to the first draw loans, it was still limited to the 10 million, which is what was in the CARES Act, 10 million per business. But the second draw loans, they put a limitation of 2 million on it, and that includes if you had some affiliates. You are still allowed to use 2019 as your base in order to calculate what they're calling the maximum loan amount. So you would take all your expenses, your payroll expenses, including the benefits and the taxes paid to the state based on the wages. You add all those up and you would divide by 12. In addition, this bill is allowing you to use 2020. So if for some reason your wage expense went up in 2020 and you can get a larger loan amount using 2020 numbers, then you can do that. I think that that's probably a limited number of businesses that this will fall under, but it's possible. And then the third option is to use the 12 months prior to the date in which you apply for the loan. Now, this appropriation expires at the end of March. So by March 31st, you need to have applied for the PPP 2.0. So it's almost more work than it may be worth to use a rolling 12-month up to the date in which you take the loan, as opposed to just using 2019 or 20. So in the PPP 1.0, businesses had to have less than 500 employees. In order to make this more favorable to small businesses, Congress changed that to a 300 employee limit. And so anybody who had more than 300 employees would not be able to get a second draw loan. In addition, they are requiring businesses that are taking a second draw, not a first draw. So if you didn't take it in 2020 and you're now taking it under this bill as a first draw loan, that this limitation does not apply. But if you're taking a second draw, you must have had a 25% reduction in your gross revenue in any quarter 1 through 4 of 2020 when comparing to the same quarter of 2019. So I've had several clients that this applies to, because with all of the shutdowns that took place in 2020, many of them had 1, 2, some of them even had 3 quarters in which they had a 25% reduction. So normally in a normal year, a 25% reduction would just be absolutely devastating for businesses, but we're all learning to live with less now. And so many businesses survived even though they had a 25% reduction, and now they're able to apply for this second draw loan. Well, I'm going to go back one just to, with regards to the restaurant and hospitality industry, and this is kind of a kicker or a huge benefit for the restaurants. If you experienced a 25% reduction in revenues and you have less than 300 employees, again, the affiliation rules that applied for in the CARES Act, what I'm calling the 1.0 version, those affiliation rules still apply, but restaurants are still exempted from it. So restaurants with less than 300 employees per location who had a 25% reduction just on their own without applying affiliation rules and looking at their brother sister companies, then they can get 3.5 times the average payroll costs. So Congress essentially gave them an extra 40% over what they had in the past, which was pretty nice.
That would significantly help smaller mom and pop restaurants too, wouldn't it?
It absolutely helps the smaller mom and pop restaurants that are in town here, especially. Yes, it's a big provision. There are special rules when you're trying to calculate the reduction in the revenue for borrowers who are not in business all of 2019, and I suggest you talk to your accountants about those rules. I'm not going to go through all the nuances here, but needless to say, they have thought about businesses that came into being in 2019. The second draw loan cannot be taken until a borrower essentially has used the money prior to getting funded for their second draw. They have to have used the 1.0 loan in its entirety before they'll fund for the 2.0 loan, which makes sense because if you haven't used it, for most businesses, they're past the 24 weeks that they had on the first loan, and so most of them will have already have had to use it, or they're going to have to pay it back. And I think if they didn't use it all, they can't do a second draw loan. As I said, the affiliation rules do apply to the second draw, just like they did in the 1.0 program. The documentation and the calculations are essentially the same for the 2.0 and as they were for the 1.0. One of the benefits that Congress put in this bill, and I'm finding a hard time with banks because they're not following these rules, so I'll just give you a little bit of warning about that. But essentially what Congress had done and said, if you had calculated your initial loan based on calendar year, the 12-month information ending December 31st of 2019, and you plan to do your second draw loan using 2019, and you're using the same bank for the second draw as you did for your initial loan, then you shouldn't have to provide any documentation other than a document that proves that you had a greater than 25% reduction in gross revenue in 2020 when comparing that to 2019, and fill out an application. And so they were trying to make the program super simple. Now, I've had multiple banks that have said, we know that's the rule, and we know that's what Congress intended, but we're going to make you do it anyways because either they're using a different system to do their second draw than they did for the original loans, or they're using a different company to help them process it, or they're just being lazy and they don't want to go back and look through their records. I'm not sure what the answer is, but multiple banks have told me that they are requiring people to fill out and provide documentation, even though the bill says it doesn't. As I mentioned earlier, the last date to apply for the second draw is March 31st. I say that with a tiny grain of salt because I don't know what's in the Biden $1.9 trillion bill that they're trying to get through now. Much of that money is supposed to be stimulus money, so it would not surprise me if they extended the PPP program, they added more appropriations to it, and obviously, if they do that, then likely they'll move it past the March 31st date. With the slow rollout of the vaccines, I don't think this is going to go away by March 31st, and I think Congress probably recognizes that too.
Do you have any suggestions for our viewers on how to document their costs to make it easier to fill out these forms?
So if you're using the full year numbers, it's much more simple to do it. So essentially you need to have just a couple of major documents. One, you need to have your payroll register that shows your payroll's made from January 1st through the end of the year for either 2019 or 2020. You have to have all 4 quarters of your Form 941, which is a quarterly filing for your payroll taxes, as well as the DE9 and the DE9C, which are California quarterly payroll tax reports. So you would have to have all 4 quarters of each of those. Not that hard to get. And you have to fill out the application, and you would have to prove if you had made payments for health insurance or for disability insurance, vision, dental, all of those, you'd have to prove that you had made those payments. So it's not 5 minutes of work, but it's probably also not 20 hours of work. So it's not too bad. And again, if you were planning on using 2019 for the second draw and you'd use it for the original, your bank may just allow you to submit an application and the proof that you had had a 25% reduction, and that may be all. So I would consult your bank, excuse me, before you go to all the work of pulling everything together. Does that answer your question,
Yes,
Kara?
thank you.
There was also another just absolutely beautiful taxpayer-friendly provision that was put into the CAA-21 with regards to the employee retention credits. So you may remember at the beginning of this presentation, I had said that if you had taken a PPP loan, you couldn't take the employee retention credits, even if you had had a 50% reduction in your revenues one quarter in 2020 versus 2019. You just couldn't do it. So under the CAA 21, they took the benefit, what I'll call the ERC, that had originally expired on December 31st of 2020. They extended it to June 30th of 2021. They, for purposes of the credit that for 2021, you now only have to have a 20% reduction in your gross revenue in any quarter when comparing it to the same quarter of 2019. So instead of looking at, for instance, the March 31st, 2021 quarter, you would compare that to the March 31st, 2019 quarter, not the 2020 quarter. So that's something that I think a lot of people are missing when they're doing their calculations. You actually need to look back a second year, not to the prior year. It also allows you to, or borrowers or taxpayers, to elect to look at the quarter ended December 31st, 2020 and compare that to the December 31st, 2019 quarter. And if there was a 20% reduction in that quarter, then for 2021, you could use get the employee retention credit for the first and second quarter of 2021. It doesn't impact what happened in 2020, but it, excuse me, it does allow you to use it for 2021. And a 20% reduction in revenue is a lot easier threshold to meet than the 50%. I'm sorry.
On that note, we're going to cut to a commercial break real quick, and then we'll be back with my guest, David Hathcote.
Great. Thank you.
If you're on Medicare and Medicaid in the state of California, you may be able to get more benefits at no additional cost. A United Healthcare Dual Complete Plan combines your Medicare and Medi-Cal coverage to give you more benefits than original Medicare. If you have Medicare and Medi-Cal, call Paris Cluff, an independent insurance agent, at 559-825-1678. That's 559-825-1678. This plan is available to anyone who has both medical assistance from the state and Medicare.
With Organic Pastures Raw Milk, you're getting a product that has been meticulously managed from grass to glass. From our pastures to our dairy, creamery, and distribution, we work hard to produce a product that is safe and clean for you.
Got lactose intolerance or dairy allergies? Discover delicious raw milk and discover dairy the way it's supposed to be. We provide tours and would love to see you. Come visit the cows, watch the milking, the cheese being made, and learn all about raw milk. We're just 20 miles south and west of Fresno, California. Call to schedule a tour at 559-846-9732.
Cremation and burial planning. Simply speaking, we need to talk. Are your final wishes cremation or burial? The three most frequently asked questions about planning your cremation or burial plans are: 1. If my death occurred tomorrow, my funeral would be arranged by whom? 2. If my death occurred tomorrow, the money needed to pay for my funeral would come from where? And 3. If my death occurred tomorrow, I would expect my funeral to cost. Call today to set up a time to talk and pre-plan your final wishes. Call Ross Rice at 559-325-1201. Email Ross Rice at ross@riceinsbenefits.com or visit rossrice.myhomehq.biz.
Welcome back to Food and Facilities. I'm Tara Sweeney, and I'm here with my guest, David Hathcote of Irwin Jackson Hathcote and Wang CPAs, and we are discussing the Paycheck Protection Program loan forgiveness. And David, you were discussing the employee retention credits under the CAA-21.
Yes, thank you, Tara. So one of the things I didn't touch on is the credit and how it's calculated. I didn't touch on that before because, like I said, almost nobody took advantage of the credit, or at least nobody I know that took advantage of the credit under the original CARES Act. But originally, under the CARES Act, it was a 50% of qualified wages per employee for the quarter in which the employer had a 50% reduction in gross revenue, and that credit or those wages capped at $10,000 for the entire year. So if you had an employer that had paid somebody $10,000 per quarter, and they qualified, let's say, for the third and fourth quarter, the maximum credit was still $5,000. It was 50% of the first $10,000. Under the CAA 21, as I mentioned before, they had the reduction in revenue was reduced down to 20%. So you only need to have a 20% reduction in revenue. And the credit is now 70% of the qualified wages, still up to 10,000, but instead of 10,000 cumulatively for the year, it's 10,000 per quarter. So while in 2020, the maximum credit was 5,000, in 2021, the maximum credit is now 14,000. So it's 70% of 10,000 for quarter one, 70% up to 10,000 for quarter two. You add those together and you get a $14,000 credit. These are true dollar for dollar benefits, and they come off of your Form 941 that you file with the IRS and it reduces the amount of payroll taxes that you would otherwise have to pay. If your credits are greater than the amounts that you would have had to have remitted, you can file Form 7200, which allows you to actually get a refund each quarter for the excess credits over what you were going to pay. It's really super, super powerful. I mean, if you had 100 employees and you qualified for quarter one and quarter two, and you paid them each $10,000 a quarter, which works out to about $20 an hour, maybe a little less, you could end up with almost a $1.4 million benefit under this program. Unlike the PPP program where the money is clearly tax-free, that is not the case, I don't believe, with the employee retention credit.
But this is a financial lifesaver for a lot of companies that were struggling, and then it's also kind of a reward for companies that were able to keep it at a 20% reduction instead of the original 50. Correct.
This provision here in 2021 really could be a lifeline, because as we mentioned and we read in the papers, especially for those of us living in California, the lockdowns are likely not going to end anytime soon. So I think that small businesses are going to continue to struggle for at least the first half of the year, and this employee retention credit could just be a huge benefit for them. The affiliation rules that apply to the PPP also apply to the employee retention credit. And one of the bummers for the restaurant and hospitality business, and I'm not sure why Congress didn't do this, but they did not exempt them from the affiliation rules for restaurants. So not only do you have to look at, well, the biggest thing is you have to take and combine all of your businesses. So if you have a restaurant that has done fantastic and you have three others that have been losses for the year and have had huge losses in revenue, you have to add all four of those together to determine if there was a 20% reduction. You can't just look at the three and take the employee retention credit on those three and not take it on the fourth, the one that has done well. You have to look at all of them. The flip side of that is if they were all equal businesses and three had a loss and your profitable one didn't, you would be able to take it on all four because likely you would meet that 20% across all four of them. But if you've got a large profitable one and you have three smaller, not profitable ones, you might be locked out of it. Whereas under the PPP program, those rules would not be applicable. I think I mentioned earlier, you can elect to look at the fourth quarter of 2020 and compare it to the fourth quarter of 2019. But that's only for purposes of calculating whether you're eligible for the first quarter of 2021. It doesn't help you get the fourth quarter 2020 credits. It's only for the 2021 credits. The CAA 21, as I mentioned earlier, it only reduces the reduction in revenue from 50 to 20 for the 2021. The 50% still applies for the 2020. As you can see, most of these rules are extremely complicated. There are hundreds of pages of code, of law written about them. So I would suggest that you reach out to your tax advisors for assistance, or of course you can always reach out to me here at Irwin Jackson, Hathcote and Wayne. Tara, I appreciate the opportunity to discuss this. Do you have any questions that you'd like me to address?
I think you covered all of them really well. Thank you for speaking with me today, David, and I look forward to sharing any updates that you can provide our readers and listeners with.
Sure, I'd be happy to do that. Thank you so much.
Have a good day.
You too. Thank you.
And one of our sponsors today is Dynamic Coatings Incorporated. They're a concrete restoration and flooring solution. They are USDA, FDA, OSHA, and HACCP approved. You can visit them at www.dciflooring.com, or you can give them a call at their Sacramento location, 916-485-6800, their Oakland location, 510-352-7000, and their Fresno location, 559-225-4605, or their Los Angeles location, 562-634-9887. And my second guests today are R&D Tax Incentives, Ron Beglin and Carol Burke. Ron is the principal, and you can reach him at ron.beglin, ron.beglin at rndtaxincentives.com, or you can give him a call at 559-612-4343. And they're going to be discussing research and development tax incentives with us today. Welcome.
Hi, Tara.
How are you doing today, Ron?
Good. Sorry, I just joined a little late. I apologize.
It's all good.
Hi.
Can you give our readers and listeners a little more information about you and R&D Tax Incentives?
Sure. We're a Fresno-based tax consulting firm here, and we specialize strictly in a few tax areas. We actually get referred in by CPAs because we're specialists in those areas. And the specific areas we focus on are research and development tax credits, which are a retroactive tax credit that employers can receive if they qualify. We actually do the actual study for the clients, and so we provide that to the clients as well as their tax preparer. So we work in collaboration with them. And we also offer a specific tax credit, which is called cost segregation, and it's for any business owners that own a building. It can be a significant tax savings for them. And so what we do is we specialize in both those areas, and then we're definitely a benefit for any employers that have any of those two criteria that would fit.
And can you give us some more information on the types of companies that you've done work for, or an example?
Yeah, certainly. We've got a nut processor that is, we did a tax credit study for. He brought in a brand new blanching line. This was a new process for them. From that standpoint, they had actually purchased over $3.5 million of equipment to have this blancher. But it was testing of the product to make sure that the end result was to the quality of the product they needed. And so from that standpoint, not only did the supply cost for the nuts they were using, but the wages of the employees, the consultant. And so what was nice is the product they were using for the almonds, they actually sold the almonds, but still got to use the supply cost as the tax credit. So it was some definite big benefit for the client. So it was a very successful product or study that we did for a client. Also have a nut processing equipment company. They actually created a customized equipment for this client. They use a lot of stainless steel equipment. They did the study, or we did a study for them, and they actually got $2.5 million back from the IRS and from the Franchise Tax Board, being that this was a retroactive tax credit. So it was a successful credit for them as well. And it was a big influx of cash back to the client.
And your colleague Carol Burke has a presentation about your company for us today?
Yeah, Carol's a tremendous asset. She's been a consultant for years in the payroll area, as well as she's now into tax credits. And so she's our business development officer that runs this, and she's a tremendous asset.
Well, thanks, Ron, for that great introduction. So our specialty at R&D Tax Incentives is really helping businesses reduce taxation. And one of the areas is cost segregation, which is an engineering study through the CARES Act. And this can really be one of the most advantageous tax strategies available to property owners. And what it does is it accelerates the depreciation of your building, of your new building, or if you're renovating an existing building, it kind of brings it into a shorter category. So whether you bought a building, you're renovating an existing building, we can compress that 39-year cycle of owning a building, compress that depreciation schedule down to 5, 7, or 15 years. And what we do is a complete engineering study. So we look at blueprints. Are you using regular bulbs or LED lighting, carpeting or tile? All of this and more go into the calculation. And then we do a no charge pre-analysis. So we show you your ROI and see if it makes sense to you. It's kind of like, I think about winning $1 million. You know, do you want it now or do you want it later? I think most people would say they want the $1 million now. So, and the nice thing with this is there's no amended returns, and it's a real tax deductible business expense. The other area that we specialize in is research and development tax credits. So what is it? It's a dollar for dollar offset of what you owe for federal and state taxes. So this is a tax law that was used to be for big pharma companies, but thanks to the PATH Act in 2016, this became a permanent law. And now it opened it up for other industries. But manufacturing, as you can see on this chart, is the majority awarded at about 62%. However, any company that is creating a product, developing a product, improving on a product or processes, any one of these can qualify. So whether you're information technology, you know, writing code, or professional tech service, startup companies, all of these can qualify for the R&D tax credits.
Can you share your screen with us, Carol?
I'm sorry. I thought Ron had put that up. I apologize.
It's all good.
I will in a second.
I have it, Ron, but I thought
Go ahead. I'm sorry.
I thought you had put that up.
I apologize.
Okay. I've got it. I'll share it.
Thank you. I had the easy part, Carol.
I know what's
Sorry.
going on. Okay. Are you seeing the screen now?
Yes.
Okay. So this was the chart that I was talking about. And then it does show that the manufacturing is about 62%. However, there are other industries that can also qualify for these tax credits. So regardless of what you develop or what you're improving on, the activities that you perform must pass each of these elements. So it has to be one of the components under each of these subcategories. So are you developing something entirely new or improving on a product, a process, or process improvement, computer software, technique, formula? Maybe you're inventing something. But when you're developing this product, did you have some type of elimination of uncertainty? So some type of capability or methodology, trial and error to improve the product. And what they're looking for is, where was that uncertainty? And when you look at 2 and 3 kind of go together. So when you're doing this elimination of uncertainty, was there some type of evaluating of alternate designs, some testing of hypothesis? Maybe you're using 2 different approaches, or we did some testing to make the product better. The IRS just wants to see that you tried, even though you failed. And then lastly, do you rely on technology when you're developing your product? So it has to be one of these hard sciences, either physical science, biological science, computer science, or engineering. And these are some of the examples of tax credits that we've helped recover. So from a fabrication manufacturing company to specialty equipment developer, construction firms, software developers. We mentioned technology startup companies can also benefit from these tax credits. Wineries, one of my favorites, craft brewers. All of these we can help recover. Now, when we're looking at this fabrication manufacturing company, this guy had 6 engineers. Ron met him at a trade show. He had no idea that he qualified for these tax credit. And he's such a great guy. Instead of buying a boat or a big house, he actually started a fund for his employees' kids. So I thought that was pretty cool and definitely worth mentioning. So we do a complete feasibility study. This is all done free of charge, just to make sure that companies qualify within the law. So we ask for some high-level information at first during our discovery call, just to see the value of the study. And we go through these qualifying questions. So, are you creating something, or do you have an existing product that you're changing some processes or process improvement? Did you rely on those hard sciences? Was there that uncertainty? Did you utilize some process of experimentation? And this is a big one. Do you own the intellectual property? Because the company that owns the intellectual property gets the tax credits. So, and also, this is a provision to reward companies doing research and development in the United States. So your employees must be working in the United States, as well as if you have any type of contractors or subcontractors, part of their process can also be tax research and development tax credits. So, we're really here to help these companies get their well-deserved tax dollars back in their pocket. And because there is these are retroactive, so 4 years for state and 3 years for federal, it can be a real huge influx of cash to businesses, and especially during the time of COVID has been a huge help to a lot of our clients. So it really costs nothing to find out if you qualify. So give us a call and we'll walk through the process with you. Thanks, Tara, for letting me share this information. If you have any questions that our subject matter expert, Ron Baglin, can answer.
Thank you for sharing, Carol.
Yeah.
And Ron, would you say that the cost segregation would make long-term costs more viable, especially now, because it would give a little more liquidity to your clients?
Absolutely, and the area of this, we're doing this for the client. We'll look at the analysis, and number one, does it make sense for the client? If they don't have a taxation issue, then it's probably not worth going forward with this because there is a cost for the study. However, we'll determine that. I always kind of give a scenario that if a person is in their 20s and they buy a building, it's maybe not worth going through the study because they're probably going to look at using those, the depreciation for the full years you can get up to, it's within a 39 and a half year period. However, if somebody's in their 40s, 50s, 60s, am I going to be in business for another 39 years? Is that even worth it? Well, why not compress it and take the advantage of it right then and there? So when it's a carry forward credit, so it can really be a huge benefit for businesses. And there's some other tax benefits as well. So when we work in combination with a CPA, the nice part that you brought that out is that because this is an engineering study, this would pass audit. So the one thing we always do for our CPA partners, being that they are tax experts, they rely on us because we are bringing a compliant product to them that follows all the compliance within the IRS and for the Franchise Tax Board.
And a lot of our local organizations don't even realize that they're technically manufacturers and could qualify for these credits. What are some smaller organizations that you, like industry-wise, that you think would qualify?
Carol mentioned a few areas, anybody with technology, but in the food industry, there's a lot of companies that will have test kitchens or they'll do some new, they're trying to look at different shelf lives. The texture and taste is not as well into the R&D part of it. However, if they're doing different packaging, different types of iterations. I have a company we work with that went into a new tub. So they were trying to put their product in a different packaging area that really was a big benefit for a tax credit. So when we talk to clients, we always look in their history. What have you done in the past 3 to 4, 5 years? What changes have you done that has come out with a product? And it might be that they just tried a new business component and it didn't work. Well, they spent a lot of money in that area. Why not give the benefit of what the credits could be for them? So we'll actually get in that and dive in and really work with the client to understand what their business model is.
And what would you say a lot of your clients have had issues with during the pandemic?
Well, obviously, it's been a huge, I'll tell you some areas that there are some companies that have just strived. I am working with a company that they create PPP equipment, and so their business component has just, they've had a bumper year from last year, but others are struggling. And so I have some other equipment manufacturers that have slowed down. So what's happened in that sense is that they're looking for the cash. They are needing it. They also have applied for the PPP, and David was on earlier, and he's definitely an expert in that area. But the client might also need some relief or money they can get back from the R&D tax credits, our research and development. So definitely it's something that we can provide the client and just do the analysis for them. So can be a tremendous asset for them and help them out on their bottom line.
Well, thank you for joining me today, Ron. If our viewers and listeners wanted to contact you and Carol, how would they reach you?
I can be reached, both of us can. I can be reached directly at ron.beglin at R&D Tax Incentives, and Carol as well, carol.berg at R&D Tax Incentives. I think we have information we can provide for that if there's anybody would like to get a hold of us.
Thank you for joining today, Ron, and I hope you have a good day.
Thank you. Have a great day.
You too. And our final sponsor for today is Fine Print Plus. They're your source for printing, packing, and promotion. They have a $500 free business card with purchase of $20 or more for new customers if you mention this ad. And you can reach them at 559-237-4747. Give them an email at graphics@fineprintplus.com or request a quote at fineprintplus.com/quote. And now we will have a moment of silence for our Black Lives Matter community.